Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin. Thank you.
Good morning, and welcome to a Moss Adams webcast. I'm Katie Soderberg, the webcast producer for today's presentation, Get Growing, How to Build Value in Your Business. I'm pleased to introduce you to our presenters for today's session. Alan Hungate leads the Moss Adams Valuation Services practice, supervising and reviewing business valuations for a wide variety of purposes, including mergers and acquisitions, estate and gift planning, financing, and litigation. He is a chartered financial analyst and an accredited senior appraiser. Tom Zambito has been active in business valuation, financial reporting and analysis, and financial valuation modeling since 2000, and has extensive experience serving companies ranging from startups to multi-billion-dollar revenue corporations to meet their financial and tax reporting requirements. So with that said, I'm going to turn the webcast over to Alan to get things started. Alan, the webcast is now in your hands.
Thank you, Katie, and thank you everyone for joining us this morning. So today's topic is how to grow value in your business, and presumably those listening today are interested in doing just that. We will go through a list of kind of our top 7 things we've identified. We'll do a little case study and then some concluding remarks. But really, when you think about it, the value of a privately owned company is usually one of the most important assets of that owner. And knowing that value and knowing how to drive that value higher is one of the things that can just kick off a lot of top-level strategy items for the company, such as, am I earning an adequate return? Do I have a good exit strategy? Is my value high enough to exit, or do I need to build it up higher? In my years of experience, certainly I'm always surprised by owners who usually have an outdated, inflated idea or notion of the value of their company. And so knowing what it's worth and how to get that value higher is really important. So before we get into how, the top 7 drivers of value, just a quick primer on what we as appraisers look for when we're trying to determine value. And to many of you, I hope this looks a little familiar. We have 3 basic approaches: the income, market, and asset-based approach. The income and market approaches are usually the more prevalent or the more heavily relied on, and I'll talk about those a little bit more. And then the asset approach is usually the least relied on method. So you think about it, the income approach is essentially just how much earnings is this company generating? What will an investor expect in the future with respect to earnings? And we go through, a pretty detailed methodology and convert those future earnings back to a value today. So for a company that maybe has pretty high growth prospects, they expect things to really look different in the future with respect to, growth in revenue and growth in profitability. Really, that income approach is going to be most likely the most dominant approach that we'll look at. The market approach is really assessing what other companies are selling for. And, you look at the public markets, you look at transactions that have happened in the private marketplace, and you can develop some multiples that really help give you an idea of what's happening. So instances where the market approach might be more relevant could be perhaps a high-tech company with lots of good competitors and comparables in the market where you can go and measure exactly how they're trading. And in that instance, that might be the more heavily dominated approach. And then lastly, the asset approach, like I said before, it's usually the least used. And it's usually the situation where either you have an investment holding company or your prospects are so poor that really investors are looking at those assets really hard and saying, how much cash can I get out of this thing? So usually that's kind of the lowest approach that we see.
So now we have our first polling question. And as a reminder, you do need to participate in polls to earn CPE. So please select one of the options and click the submit button. The question is, what do you believe the value of your company to be? Whether you're an owner on the telephone, a CFO, a controller, etc. Do you believe your company's value to be less than 10 million, between 10 and 30 million, between 30 million and 50 million, or greater than $50 million? We'll give you a few seconds here to click. And for those of you who are from public companies, feel free to look at Yahoo Finance if you don't know the value of your company today. And based on the polls, looking like a nice round mix here, with about 30% thinking their company's worth less than $10 million. About 31 or a third believe that their value of the company is greater than $50 million.
Good. Well, that means we have a good broad audience here. So this next slide is kind of a slide about multiples. As you hear in finance and probably throughout your career, you hear things like, oh, I just heard our competitor just sold for a multiple of EBITDA, and the multiple was a 5, or the multiple was a 7. It's a very common term to hear about, so we thought it would be good to just show how these multiples are developing. And I'm going to turn this over to Tom in 1 second. One of the other comments I would make is, in our world of appraising, we do see lots of private equity firms that are in the marketplace, and one of the things they look at is EBITDA, which, earnings before interest, tax, depreciation, amortization, and also they want good management. One of the recent fellows I was talking with said they have paid upwards of 10 to 14 times EBITDA in the last 6 months. This individual also described today's environment as one of the most rich or solid in terms of deals that are getting done, that the multiples are very good. And another just thing to remember too, we hear about cash being on the sidelines ready to be invested. If that cash doesn't get invested, those private equity funds need to return it to the investors. So there's kind of a pent-up demand to get that cash working. And now I'm going to turn it over to Tom to talk about the multiples.
And just speaking about the cash, Alan, I was reading recently that there's about $1 trillion of cash just sitting out there on the sidelines. And so people are wanting to do something with their cash. They're, kind of tired of the low returns of just parking it in, some debt or parking it in a bank. And so I think a lot of clients that we're talking with are pretty excited. I think they're getting back to the point where I want to sell my company. What do I need to do? And a lot of the companies that we talk to, as Alan was saying, ask the question of, well, my competitor sold for, 7 times EBITDA, or I heard through the rumor mills that, this company is acquiring companies for 6 to 8 times EBITDA. What do I need to do to get there? And so some of the information that we share with them is related to, okay, how big are you? Because a lot of times we hear talking with investors or talking with other companies that they're sometimes not interested in companies until they've reached that $3 to $5 billion EBITDA level, for example. And so you're looking at 10, 20, $25 million companies. And as you see in the table here, the greater your revenues are, the potential you have for a greater EBIT or an EBITDA multiple. Now, the one thing to remember is that there's a lot of information, and when you're looking at averages, there could be a company who has $50 million in revenue that gets a 14 times EBITDA multiple or a 14 times EBIT multiple, and so it just depends on a case-by-case basis. And what we tell our clients is, let's look at the synergies. Let's look to see what you have. Let's compare you to XYZ companies and see what is out there.
Right, and I think the other thing I heard too is back to the $1 trillion you mentioned, Tom, that sometimes the bigger companies get higher multiples because those private equity funds get more excited when they can put to work a bigger chunk of that cash. And that might be one of the reasons value is getting driven higher.
Exactly, and there's also add-on opportunities in the market, adding on a number of companies together that they believe could then be either sold to a larger company for a much higher price or perhaps going IPO. And the same thing works with a strategic buyer. If there's a lot of synergies in the market, there's a potential. I remember working on one project a few years ago, an international project in the telecom space, and the asking prices were all over the board. The company had a number of different analysts working on what's my value, and then of course a number of the potential buyers also had values out there. And I think the winning bid was $5 billion, but companies both strategic and financial were all over the place, and that ranged from $1.5 billion to I think about $5.5, $6 billion. And so the company that sold itself was going for the best fit. And sometimes that's what you need to look for. Maybe someone is going to offer you a 10 times EBIT number or a 6 times EBIT number, depending on the industry you're in. But but there might be a better fit going with a lower multiple. It depends on what you think the growth is going to be going forward. Now, in this particular slide, I'm kind of bringing everybody back to Corporate Finance 101. As your risk decreases, your discount rate decreases, and your firm value is going to increase. And I think what we're going to show in this presentation is that for these areas that we're talking about where we believe you could perhaps improve on in order to build value, if an acquirer is coming in, or if some of you are the acquirers on the telephone, if you're interested in buying companies, you're going to want companies that have a lower risk, and with that, you're willing to pay, a higher dollar amount.
Polling question number 2, again, to get that CPE, click Submit. Why are you interested in determining company value? And there's 6 items here: transactions, estate planning, restructuring, option granting, or perhaps you have litigation going on. We'll give everybody a few moments to click Submit. All right. And not surprisingly, what we're hearing and seeing in the marketplace is also affecting everybody else this morning, and that's transactions. There's a lot going on out there. All right. Now, this slide, why am I great? Let's dance. This is a perfect setup from the last slide. Folks are interested in transactions. One of the things I like to think about is, let's take it to maybe the ultimate level. Let's say your company is ready to go public. Well, in that process, the SEC comes in and says, well, you need to file an S-1 registration document. And anybody that has read those documents and poured through all, 100, 200 pages knows and can see some really good stuff in there. And what I would put out there as kind of a prospect to each and every one of us is, what is your story? What is your S1? What is your story going to say? We've got 7 things here that we've identified as part of the program of things that can drive value. But there's many things. These are not the only 7 things people need to be thinking about. But they're a good way to start thinking about, what is my story? What is my company's story? And what can I do to enhance these areas so that if I were going in front of the SEC and to the world of investors with an S-1 statement and putting all my information out there for everybody to look at, what would it say? Why are we great? How do we produce revenues customers? Why do they keep coming back to us? And how can we get them to tell their friends? And ultimately, here's our financial results. See how great we are. So, with that, let's move right into the first area. Dedicated workforce. And I should have said here too, dedicated workforce and management. Having this asset in place for you is absolutely critical. There's a few words here that we all can relate to. People create intellectual property. They are the company's culture. Diversity is always healthy. It can give you a competitive edge. Are your team and its management have a good balanced work life? All these things together can create, a valuable workforce. So, one way to think about this is to measure kind of the opposite of it, which is, how expensive is it to me and to the company if I have high turnover? We all know there are some very strong short-term costs we have to deal with. Perhaps there's recruiting costs. Certainly some productivity will suffer. Management and owners will need time to interview candidates and get comfortable. And then long-term, if this is a trend, then you get to some deeper issues that can really affect the whole group in terms of morale and culture issues. One of the things we focus on when we look at companies is this aspect and management. And we'll ask, how old are the key people? How long have they been there? We like it when we hear things like, well, we have a highly trained workforce that's been here on average 7, 8, 9, 10 years. When we find companies on that level, they tend to be better producers. So let's keep going with this concept and let's measure the value if a company were able to reduce their turnover. Now here's a real quick example. We have a key person at a base salary of $100,000, load them up with benefits, and you get to $128,000. Now, if they were to leave, let's assume there was going to be a recruiting cost for that person of $25,000, and then they're going to be unproductive their first year also, about 20% of the time when the new person gets hired. So you add those costs together, and you get, in this example, total direct costs of roughly $50,000. And as a percent of the fully loaded employment, that's about 40% of the number. So again, with this example, let's assume we have a company that has a wage base, fully loaded costs and everything, of roughly $2.5 million. And they experience, on average, 25% turnover per year. Now, this might be really high for some people, and it might be low for others. It is going to vary across industries. In this example, though, that annual cost is about $250,000. Again, using that 40% indicator from the prior slide. Now, if they were able to reduce that down to 18%, we can see that the direct cost from the turnover declined to $180,000 in this example, and it used to be $250,000. So we have a savings of roughly $70,000. And now I'm going to break all the rules and go back to that EBITDA multiple and say that if this company were being valued at a 5, then if that would translate to an enhancement of their value of $350,000. So again, this is just an example of if you do have a situation in your own company where the turnover feels high, seems high, maybe it's high relative to what your competitors are doing, then here's an example of how that could affect your bottom line and be an immediate impact to value. Now I'd like to turn it back to Tom.
Okay, so the second area that we'd like to speak to you guys about is relationships. What do we do about relationships? Are they important? Do I need sticky relationships, or am I a commodity? And I know that people are going to come in all the time, and I don't really have to worry about word of mouth or anything like that. And so what we've found is that for the most part, the clients that we're working with, you want to maintain those relationships. You want to be able to nourish those relationships. You want to make it difficult for someone else to come in and take over those relationships. I know for us in our industry, relationships are extremely important. I mean, we do everything we can to make our clients happy, within reason. And we know there's a lot of choice out there for other evaluation firms for them to go to, but we work with them, and hopefully we're making them happy, and we kind of foster a culture, if you will, and relationships that are long-lived. The customer experience is critical. They say no one can compete on price and or product alone. And, what we found is that anything negative that happens in the marketplace these days, spreads virally. If you've had a bad experience, you've seen it up on Twitter or you see it up on Facebook. And companies nowadays have people that are watching that. If something bad happens, they try to, kind of put the fire out, if you will. And so how do you measure the value of your relationships? Well, I mean, I think one way is, how is your business growing? Are you seeing an increase in revenues? Are those revenues coming from new people? Or are you seeing a decrease in revenues? Are you seeing an increase in expenses because you're spending a lot of marketing time, sales time, and not really getting anything in return? With banks, for example, that we work with, we look at the core deposit intangible. In a way, that's a customer relationship. How sticky are those relationships? How good is that? that deposit of the bank that you're looking to acquire. For our retail or restaurant clients, those customers come and go. Sometimes you'll have a customer in and they won't come back for a couple of years. Or maybe you have those people. There are those restaurants, for example, that I go to all the time, and I've become enough of a customer for them to say, hey, how are you? Same thing with, on the retail side. And then on the other side, we have some, companies, clients who have very excellent relationships. Sometimes, however, they have relationships with very few people, and they're doing great right now, but, what's going to happen in the future if one of those relationships goes away, and that relationship is, 80% of their revenues or even 50% of their revenues? What happens on that day? So it's good to, kind of maintain and also nourish relationships, but also go out and look for relationships. And we're not saying that you have to keep the relationships that you have today, because sometimes maybe some of those relationships are unhealthy or unproductive, and they are causing you stress, or they're costing a lot of money. Look for those relationships that are going to be productive, that are going to be healthy. We're using a couple of different examples here. Our first example, very simplified. There's a lot missing from here, but wanted to keep it very simple since we only have an hour. But in this particular client relationship, they have 95% retention. So at the beginning of year one, you have 100 customers.
And Tom, this is an example of just how we might value a relationship, right?
Exactly.
Yeah.
Exactly. There's a few other pieces to valuing this relationship, but again, just to kind of keep it simple for the time being. In these two examples, in the first example, we're looking at a company that has 95% retention. Very, very good. They start with 100 customers at the beginning of year one, and by the end of the year, they have 95% retaining, or 95. And then over the next 5 years, they're losing. They're able to obtain 95% retention, and so by year 5. In this example, they have 77 of their original customers, or the original 100, that have retained. Operating profit, tax. In this example, we have a discount rate at 17.5%, and ultimately, just from those 5 years, we have a value of roughly $500,000. And just with one simple change, all else equal, if we have a relationship with a 90% retention. In this case, what happens is that at the end of year 5, as you see, you're down to 59 of your original 100 customers. We've kept the operating profit percentage the same. The discount rate's the same. So the only thing that's changed in this example has been a 5 percentage point decrease in your retention rate. And what that results in is, to the tune of about $100,000, or about a 20% difference in value. So relationships are key, and I think what we'd like to leave you with on this is just maintain and nourish very, very good relationships. Now we have our third polling question, and again, as a reminder, you need to participate in these to earn CPE. So, please select one of the responses and the submit button. When was the last time you had a company evaluation performed? Was that last year? Was that sometime this year? Was that sometime over the last 3 years? Was that sometime over the last 5 years? Or was that never? Again, there's no right answer, no wrong answer, sorry about that. Just give you a few more seconds to do that. Great. So what we're seeing is nearly half of the folks on the telephone have never had a valuation performed. That may be the case for a number of reasons. Over the last 5 years, about 15% of you, and over the last year, roughly about a fifth of you have had a valuation performed for any number of reasons. And I think in our earlier poll, nearly 40 to 50%, I think, of the people were involved or interested in valuations for transactional purposes, right. And then I think another quarter of them were estate planning. And I know we're seeing a lot of people thinking a lot more about estate planning, thinking about, gifting to their children or other relatives, or even to employees, gifting to their employees, or kind of setting up something like an ESOP, or other, perhaps, some of our clients have been thinking about grafts as well. So what else does a company need to do? In our third area of building value, we want to touch on marketplace presence. And what does that mean? I mean, do you have a marketplace presence? Are you like a McDonald's? And everybody knows McDonald's and Burger King and Jack in the Box. And so, you go there because you like the Big Mac, or you like Jack's commercials, and so you prefer going to go to Jack in the Box because maybe Jack is there sometimes.
What's your favorite, Tom?
I'm not supposed to say. So in terms of the marketplace presence, are you out there in the marketplace? If someone were to say, I love my bank because of X, Y, Z, is someone else going to know who they're talking about? Or I love these jeans look great on me. Is someone going to know based on the way the jeans are potentially hanging or by the tag on the jeans? Is someone to be able to pick out, oh, yes, I know you have that brand of jeans or sweater. There are some clients who are like McDonald's, for example, or like, Apple or Google, and it's word of mouth, and, they have a premium presence in the marketplace to some extent. But then there are other, clients of ours who are not very well known, that perhaps you and I wouldn't know, or many of the folks on the phone wouldn't know, but they're in a particular niche of the market, and they're very, very well known in that niche. Or, for example, friends were talking this weekend about buying a new stove, and a couple of the stoves that they're looking at are very high-end stoves, and most people, it's not in the mass retailer section. You're not going to go to a Home Depot or Lowe's and buy that stove. You're going to go to a specific dealer who deals in high-end stoves, and they're very, very well known, these companies for their stoves, but they're not known by a lot of people. But that sometimes doesn't matter. What matters is what is the market that you're going after. Mm-hmm. In terms of, I thought that this information was very, interesting that we got off of Forbes.com in their recent survey, or understanding of what is brand value. What are the 100 top brands? And Forbes isn't the only company that does that. I think Interbrand also comes out with their own ranking, and it's very interesting to see the differences between the two. And many times there's an overlap, which is great. But I think the point, we wanted to make here is that, sometimes you will need to spend a lot of money on sales and marketing, and other times you won't. And I think the one thing that struck us on this slide is if you look at Apple, Microsoft, and Google, I mean, everybody knows those names. But if you look at the advertising spend on Apple, for example, it's about, the recent information from Forbes was $1.1 billion. Microsoft at $2.3 billion, and Google at roughly about $2.8. And what does that translate into? Well, Apple has a brand value of $124 billion, according to Forbes. And according to Yahoo Finance, they have a market cap of, a couple of days ago, of roughly about $723 billion, which is, double or nearly double Microsoft and Google. But they're spending a lot less money on advertising. So very much word of mouth for this, for Apple. And also Apple is, not necessarily not knocking Apple, because I have a lot of, Apple products, but Apple is able to command a higher premium, and so you look at their margins, and they're fantastic, and they're able to translate, is the iPad better than the Kindle or the tablet? For example, I mean, I have friends on both sides of the fence. Some say, I love my Kindle, I love my, tablet, I love my iPhone, for example, or I love my Android. And so some people like things better than others, but at the end of the day, Apple is spending a lot less money on advertising. I think the second half of this table is looking at a few different retailers in terms of, at the high end you have Louis Vuitton, Hermes, and Ralph Lauren, and then kind of at the mass retailer end you have Walmart. And it's interesting to look at what their advertising spend is. And I think just one thing to point out on Louis Vuitton, this is basically a portion of their company. Louis Vuitton owns, I believe, roughly about 50 different brands, very, very high-end brands, and their revenues in total for the company are roughly about $31 billion. And so I think what Forbes is coming out and saying is that Louis Vuitton is roughly what value is coming out of Louis Vuitton is roughly about 9.7. Now we're using a lot of large companies here, but the same thing can be said about small companies. Sometimes it does take a lot to get out there in the marketplace, whether it's going to trade shows, whether it's going to conferences, and you do have to spend that sales and marketing time. And you will get up to, that point where perhaps you can actually kind of dial back on the sales and marketing side. And we've seen that with some of our clients who at the very beginning are spending a lot of money on sales and marketing just to get their name out there. And they know that there's going to be a snowball effect. And once they get to company A or company B, they start working with a Google, they start working with an Apple, or they start working with a big bank, and they know that the banks are going to use their product, and they can take it to the next bank, or they can take it to the next large retailer, and their name will get known in the marketplace. And before you know it, we've had these companies that have been, we started with them pre-revenue, and now they're, 10, 20, $30 million companies, 3 years later. And so it's very important. There's a nice mix there. And not everybody is unfortunately able to, to take part in the word of mouth as much as an Apple can. But, at the same time, if you're in that niche market, like, one of our clients, you get really well known in the tech space. And then, your phone is off the hook, like they're experiencing. And so they're having their own issues, in and of themselves. Turn it over to Alan to talk about management.
Thanks, Tom. Management. So this is another top buzzword thing that the private equity groups are looking for when they are, searching for the next acquisition. Let's look at your numbers, and you got to show them, probably 5 years worth of financials, and then we want to meet management. And if we think management is good, solid, going to stick around, there's depth, then you know what? Maybe that EBITDA multiple we talked about earlier won't be a 5, maybe it'll be a 7. It is the second most important thing to value that we see, other than just straight profitability performance. So one of the things we look at is how strong is the management team? Is there a transition plan or a backup plan? Is there a bench? Or is the company being driven from a very strong CEO who does not have other leaders at the table that can help in case that person gets hit by the bus? So that's something that's really, really important. One of the things we like to ask is, okay, and this is a very difficult question for owners. So I want to spend just a minute on this. Is I'd like to say to an owner who's actively involved in the business, if you were living in Tahiti, I call this Tahiti style of management, and you had nothing to do with your company, you were just a shareholder now, collecting your dividends or whatever. The question is, what would you have to pay somebody to do your job? And for a lot of owners, it's really surprising. That's a very difficult question for them to answer. Many get very uncomfortable and immediately try to defray an answer like, well, I've got my son's coming along, my daughter's coming along, I've got a key foreman in place, they could do the job. But really the question is this: if something happened to you, what would you have to pay somebody to do your job? And the reason that's critical is that when we're looking at valuing a company, we need to assess or impute, if you will, a market salary or an economic salary for that owner's contributions. So anyway, that's a very key point, one that will impact value a lot. And I guess the way I would describe this to the notion of building value is that if you're in a company or if you have a company where the answer to that question is, you know what, if I had lost my management team, we would be just fine because we've got this deep bench of people that could very quickly and easily take over. That is exactly what the buyer wants to hear, that they don't have a lot of risk in play with somebody, a key person leaving. And I guess the other notion is that it's not a bad idea to do some inward looking and assess a market salary on your leaders. If they also own stock, they may not be paying themselves the right number of salary or in salary. So, and that's important because when we or somebody else is trying to value your company, they will make a salary adjustment for that individual. Okay, I'm turning it back over to Tom now.
So up until this point, we've talked about dedicated workforce management, relationships, then having a presence in the marketplace. And so, people may be thinking, okay, I've done all that, so great, my value is going to increase by 10, 20, 30, 40% over the next year. But there's a lot more to it than that. You need to kind of bring it all together at the end of the day. And I think the next topic we wanted to discuss, or the next area to building value, is understanding the marketplace. How well do you really understand the marketplace? For example, for a recent gaming client that we work with, trying to model their forecast was interesting because they had some potential games in the works, and the scenarios that we were going through were very large gaps on, is this going to take, is this not going to take? Are they going to get people excited in their game, and are they going to be able to take it to that next level? Also with one of our other clients in the tech space, they're trying to figure out, well, there's a potential that there's this new competitor coming into the marketplace, and our clients, our customers may shift over to them because they can do X, Y, Z. So we need to figure out how to shift ourselves enough so that we won't lose that edge. And so it's very, very important for you to understand your customers. Maybe if you're a smaller company, it's maybe a little bit easier to talk one-on-one with your customers and understand what they want or what they need, and not that you necessarily need to follow them. Maybe sometimes you can put something in front of them that they're not even expecting. And of course, one of the a great example would be Steve Jobs and his teams over at Apple, and giving us the iTunes and the iPad and the iPhone for example, and just revolutionizing the marketplace in their own way. But also in terms of missing the mark, there's a couple of companies that come to mind. AOL, Blockbuster, kind of the Friendster, MySpace, and MySpace is there, but they had potential. A lot more potential, many years ago, that they lost. The same thing with AOL. AOL was everywhere. Everyone knew AOL. Probably everyone on this phone call, all of us here in this room, have received all those discs, or received, I've probably received about 25 to 50 of those discs, way back when. But what happened to AOL? And now they're trying to, or the last couple of years, they've been trying to reinvent themselves, and so we'll see, what comes out of that. Near and dear, to my heart is, Eastman Kodak, a company that had been a darling of investors for so many years. I had so many relatives who work for, Eastman Kodak, or for offshoots of Eastman Kodak. And I think at one point the company had more than 120,000 employees worldwide. So we think about these companies today who have had, who have more than 100,000 employees. Who knows where they're going to be tomorrow? You look at the Dow Jones, for example, 100 years ago, and you look at the companies that were on the Dow Jones, and you look at the Dow Jones today, very, very, very different. And those are larger companies. On the smaller company side, you have, it's great to see some companies grow. But there's also a lot of companies who maybe today they understand the marketplace, and we have discussions with these companies all the time, are just starting and just want to try to figure out what's my value. But after a couple of years, they're bust. They had a great idea, but they weren't able to bring it to market, or trends shifted and they lost out. So a lot of times what we talk about with clients is you need to think outside the box sometimes. And so we look at, what are the risks, and what's the analysis that you can go through to help us understand, whether or not your risks are high or your risks are low. And you look at, for example, the pestle analysis. You're looking at a political. What are the political views? What are the economic issues that I need to face? We have a current client who called up last week and was talking about, okay, 50% of my revenues are coming out of Europe. What am I supposed to do? Do I have a potential impairment issue? It's too early in the game to say yes or no, but we just want to kind of keep that dialogue moving. Technological issues. Where am I going to, be tomorrow? Is my competitor going to come out with, something that's going to be more technologically advanced? I need to kind of keep, worries about that. And just monitor the macro environment, not only the micro environment. And it's amazing how, we'll start talking with, some of our clients, initially, and they'll tell us, okay, here's XYZ, these are our competitors. And then, our analysts will start working, or we'll start working looking for competitors. And, many times we'll find new companies that are out there. And it's interesting because then the clients are like, wow, that's a great competitor. I need to keep an eye out on that. I remember at least one time where we brought a potential competitor to the client. We said, well, here, how about this company? They seem to be a good company to compare you against to figure out what your value is. And they ended up buying that company about 18 months later, which was great. So I think the key here is think outside the box. Things that are happening in Russia today could impact your company somehow. The election in Israel could impact your company somehow. And even if you're a small company, you never know, what your next step is going to be. And so just something to keep into mind. And then, kind of helping yourself understand what are my strengths and what are my weaknesses. Let's turn those weaknesses into strengths. And, helping you at the end of the day decrease those risks so that you can increase the value of your company. The sixth area we wanted to talk about was being financially efficient. Whether that means increasing your revenues or cutting your costs, that's not always what needs to happen. We have a fairly large client who's going through some tax restructuring. And they're just going to make their life, a lot easier, at audit time and at tax time. So that's making them more financially efficient. And so I think at some point, that will definitely lead to, cutting some of their costs. Some clients are debating whether or not, should I outsource? Is it easier for me? Should I set up, a manufacturing facility in the Philippines or in Vietnam or in India or somewhere? What should I do with my sales and marketing? Should I hire a new sales and marketing team? We were recently working with a company who was looking to acquire another company, and so they had us go in and value that target. And one of the discussions centered around sales and marketing. They had great management in place. They had a dedicated workforce. They were well known for what they were doing, but the one thing that they lacked was sales and marketing. And the owners of that company had indicated, they were like, we don't want to spend a lot of money on sales and marketing. We have some word of mouth. We know that we can probably double our business, but if we don't find the right sales and marketing team, we believe that we're just going to be spending, useless dollars. And so that's something for companies to think about. Do you have the right sales and marketing in place to get you to that next level? And also perhaps, if you're doing, 5 different things, maybe you don't need to do those 5 different things. Maybe you need to dispose of one of your units, or sell it, not necessarily shut it down, but perhaps there's another company out there who could buy, one of your reporting units, for example, gives you some extra cash to then use on, making some of your other units, more profitable, or getting more out there in the marketplace.
Okay, polling question. I believe this is the last one. Again, Interested in CPE and clicking submit. Which of the following does not belong in this group? And this, by the way, is our only really tough question. The income approach, the market approach, the pestle analysis, or the asset approach?
We give you a few more seconds on that polling question.
All
Great.
right.
So 80% of you picked the pestle analysis, which is correct. A little bit of a trick question, but you know, we were told we needed to at least put one trick question in there. So now we're going to move on to our last area.
Reinvesting. So as cash flow comes in and profits get generated, owners have decisions to make. Do they reinvest in the company? Do they distribute the earnings out to the shareholders? How does that look? What we have found, generally speaking, is that companies that reinvest and keep those earnings and cash flows inside the company tend to be more valuable. Now, there's a couple of, a really simple answer to that is, well, I know I can put my money to work here in the company and generate a rate of return that's higher than I could get elsewhere in the stock market or certainly elsewhere in a checking account. But what I thought I'd do here is, there's a few bullet points on this slide that talk about ways to reinvest. Certainly, and the impacts it has. If your employees see that earnings are reinvested in the company, they like that. It gives them a sense of staying power, and they get excited about being innovative and staying up to speed with the equipment and the machinery and those kinds of things. I want to jump to an example. A couple of companies stand out in my mind. One was a company that was in the food business, and what they did is, and we've been involved with this client for years. Every year I'd talk to the owner and say, okay, what's new? And the owner would say, well, we have these 10 new products that are coming out or have just come out. And I'd always get a sample of each of them, take them home, try them out. Some were clear winners and some, not so good. But my point is that this particular owner would spend almost all the earnings tinkering with the recipes, tinkering with the formulas, and just staying innovative and fresh. And over time, I came to appreciate the fact that that decision was really a great one and was really driving some nice revenue growth. Now, flipping over to the small company, this other example I have was something Tom said. A company that services metal works, and they invested in their employees and their sales force. So every time these folks were in the market, they knew exactly what to say to that potential customer. And I was just astonished at the profitability this company was showing on its bottom line. So there's a couple of quick examples of how you might reinvest earnings and reinvest in the company. All right, moving along.
So now we come back kind of full circle in some ways to this graph again, in terms of as you decrease your risk, you're decreasing your discount rate and you're increasing your firm value. Simpler, that's simply said, but if you take away anything today, hopefully it will be that you should concentrate on de-risking your company, which will hopefully lead to an increased value. And for Alan and I, we work in the concept of risk on a daily basis. We live in the land of discount rates and multiples, and they're very much interrelated, as all of you know. And so, if you have a dedicated workforce and you're increasing your productivity, perhaps you're able to, decrease those costs in a good way. Perhaps you're able to, in some ways, through word of mouth or through great relationships, increase your revenues and leverage the workforce that you have right now, and increasing revenues and decreasing some of your costs. And so the things that we work with in terms of forecasting cash flows, as Alan talked about at the beginning of this presentation. We're obviously spending a lot of time on risk, but we need to also take into account what's going on with the company. Where is sales growth? What are changes in margins? We need to understand what's going on, and we want you to understand what's going on. And a lot of times when we're working with companies on their modeling, we're putting together models for them to use to kind of test out, what happens if this happens? What happens if the euro all of a sudden goes to par with the U.S. dollar? What happens if I build this facility? I know that it's going to cost me, $2 million to do this, or if I invest in sales and marketing. So, we like to work with our clients and help them understand, okay, if you make X, Y, Z changes in your modeling, this is the potential that could come out. And then for you and I, we are working with them on, helping them understand what's a good discount rate to use. And that kind of leads us into, a mini case study, if you will. When we started looking at different companies and looking at, ways to kind of bring this presentation home, we thought about, what are the conversations that we're having with our clients today? I mean, there are some clients who want to stay status quo, or I should say, in that prior example, our client was looking to acquire a particular target, and the target just wanted to stay status quo. They were earning a fairly decent dividend at the end of the day, and they said, okay, we don't want to muck this up. We want to be able to kind of carry ourselves through, and we're very happy staying status quo. But our client is looking to grow them, and so they're looking at increasing the workforce, working on making sure that the company is out there more in the marketplace. Maybe there's some tangential areas that they could, kind of now focus in, a couple more and increasing that growth. And so just, very, very simple again, looking at, 3 different scenarios. A company that has 10% growth, 15% EBITDA margins, and a 13% discount rate, based on, an analysis that we had worked on. Scenario 2, 10% to 20% growth. They're working through growing. They have a dedicated workforce management. They've looked at, what their strengths and weaknesses are, working on their weaknesses. And so they've been able to, at the end of the day, increase their EBITDA from 50% to 20%. Again, we're keeping the discount rate at 13%. And then our scenario 3 is a company who had some good ideas. They went out and they were able to grow for that first year, second year, and then something happened. They didn't stay focused. The market changed, and so they missed out. There was still some increased growth, but lower percentage points of increased growth, and because of that, they weren't able to keep their margins. So their margins have decreased. And so if we look at our scenario 1, we see that there's been an increase. No increase, the growth has stayed constant, as well as EBITDA margin, and we have the value of the firm at, let's say, $954,000, which, for 2015 multiples that we're looking at are, 1 times sales or nearly 6.5 times, EBITDA. And sorry, that should be 7.6 times EBIT. Now, what happens in scenario 2, well, the company has now been able to increase its growth from 10% up to about 20%. They've increased their EBITDA margins from 15% to 20%. They have a long-term growth rate of 5%, which is very similar to the last company. Same 13% discount rate. And what happens here is that they've increased their value of the firm to roughly about $1.6 million through, working on some of the areas that we've talked about this morning. And looking at the third scenario here, this company started out good. They grew to 20% in 2016, but unfortunately weren't able to keep that growth up. It ultimately leads to a 4% long-term growth rate, which has impacted the value of their firm. And because there's additional risk, we've decided that there had to be some, additional increase. So a 200 basis point increase in their discount rate leads the value of the firm to $657,000, so roughly about a 15%. And so, in conclusion today, Simply, valuation check-ins are great. They can provide you an understanding of your company's value, either for a specific purpose or perhaps, you're just kind of thinking about what's my next step, perhaps for estate planning.
Right, and back to kind of the pre-IPO discussion, what is your story? What would you write about today to summarize where your company is at? And what steps can you take to grow that value?
So, on that conclusion, we'd like to thank everybody who's participated this morning. And I guess we'll turn it over to Katie.
Great. Thank you again to our presenters, to Tom and Alan, and to all of our attendees. Unfortunately, we are out of time. We had some great questions coming through during the presentation, and we'll follow up with each of you individually via email to make sure that we address all of those. And please do not hesitate to contact either of our presenters with additional questions or if you'd like to discuss any of the content of the presentation in further detail. So as a quick reminder, if you've qualified for CPE as an individual attendee, your certificate will be available to download immediately following the presentation today using the CPE widget on your dashboard. We'll also follow up with each of you who qualified via email within 2 weeks with an electronic version of your certificate. As a reminder, if you've attended today's presentation in a group and would like to receive CPE credit, you'll need to complete the group attendance sheet in order to receive that credit. If you recall, this document, along with a copy of the presentation and additional handouts on our valuation services, can be located by clicking on the folder icon at the bottom of your screen. Some of you will be redirected after the presentation to our webcast survey, where you'll be asked to provide feedback on today's webcast. Please do take the time to complete this online survey, as your feedback is very helpful to us as we continue to identify future webinar topics. And that concludes today's webcast. Thanks again for your time, and enjoy the rest of your day.